This is the Equity Management Academy weekly podcast for May 17, 2022. Gold. Has inflation peaked? Summary. Larry Summers, former U.S. Secretary of the Treasury and now at Harvard University, said in an interview on May 13, 2022, that he has been warning about inflation for some time. The overheated labor market is driving service prices up, which is at the core of the inflation numbers. Supply chains and commodity prices are making it a difficult environment for quite some time to come. Fundamentals. Larry Summers, former U.S. Secretary of the Treasury and now at Harvard University, said in an interview on May 13, 2022, that he has been warning about inflation for some time. The numbers, he said, were worse than expected, and we may hit a high last month of 8.2%. He does not believe that we're going to hit 2% anytime soon. The overheated labor market is driving service prices up, which is at the core of the inflation numbers. Supply chains and commodity prices are making a difficult environment for quite some time. Summers said that most inflations do not get stopped out by a single slowdown. They are usually multiple attempts to slow inflation before it actually slows, as it happened in the 60s and the 70s. We are also in a major labor shortage than before, which means we will see less deflationary pressures than we have seen before. He believes that the average inflation rate in the 20s will be higher than it was in the teens. More analysts are saying we should set a target for inflation that is higher than 2%. But he thinks doing so would undermine any limited anti-inflationary credibility the Feds may have. Talk of doing something about price gouging at the pump and other gouging are just danger nonsense. There is no material prospect that in any enduring way gouging legislation can have any substantial effect on inflationary pressure. But it can contrive all kinds of shortages. It can inhibit the supply responses, which is the best way to overcome inflation. Gouging talk is the diversionary confusion. The real determinants of inflation have to do with the total level of demand, which is being stimulated by policies. Policymakers, if they want to lower inflation, should lower tariffs, allow more immigrants into the country, and remove inhibitors of supply, such as requiring that ships that move U.S. crude be U.S. owned, and that the moratorium of student loan debt should continue until the economy improves and inflation rates fall. Fear and greed drive financial markets, and crypto is not immune to that. He said in relation to the crypto decline in prices, when you don't have backing and you lose confidence, he said, you have a big mess. The fundamentals suggest that gold should continue to move down. The variable changing price momentum indicator disagrees. Standard deviation and mean reversion. Gold. On May 14, 2022, Equity Management Academy CEO Patrick MontesDeOca reported on gold, which made a recent high of 2003 on April 18 to a low Friday of 1797. A low of 1704 was made on August 6, 2022. If we use that as the low and connect to the high of 2082 on March 8, 2022, we see that it was a phenomenal move in a fairly brief time. Not until January of 2022 did we begin to see the market reverting from that extreme below the mean of 1923. We use Fibonacci retracements to analyze these moves. The move from 1704 to 2082 established a trading range. The price now has come down to almost 78.6% retracement, which is normal within the confines of a long-term bull market since 2020. The bull market started in 2019 after the Federal Reserve raised rates 25 points. The 78.6% retracement is about 1784.90. The low so far was 1797, which is pretty close. Right below that level, we begin to see extreme below the mean of standard deviation levels, which indicate that the market has reached a very strong level of support. It has completed almost a 78.6% retracement and is at the variable changing price momentum indicator, VCPMI, monthly buy one level of 1844 and the buy two level of 1792. The Fibonacci and the VCPMI indicators are overlapping, which is a strong signal that the market is likely to revert back up. If gold closes above 1844 or tests 1792, if gold does that, there is a 90-95% probability that gold will return to 1923. This is a specific signal that you can use in your trading to get into the gold market with a high probability trade. These levels are where the artificial intelligence of the VCPMI predicts that buyers will come into the market and the price will rise. If you are long, don't despair. If gold closes above 1844, or if it tests 1792, it would signal that you should add to your long position. It is a great time to dollar average. It is an excellent time to enter the market at a time of spring seasonal lows and load up on gold at a low price.
Thank you. I wanted to, good morning everybody. I wanted to share this information with you here. It's a report that we published on the Associated Press. Good morning everybody. This is Patrick here with Live Trading Talk. I wanted to share this report that we just published in the Associated Press. And take a look, basically, what has transpired since. And I wanted to focus here this morning on some trading that we're doing here, and I want to take a look at basically where we are in terms of silver. We've been getting the price to enter into the sell 1 and sell 2 levels of the VCPMI. And as you can see, these levels are in red. And that alerts us as a trader that we are in an area that is called resistance, that is called basically distribution of supply. And we're talking about a high probability mathematically that the math, and this is the extreme of standard deviation above the mean, the daily mean, which is 2151. So what we do here is we trade the reversion to the mean, and we use standard deviation basically to identify high probability trades. When the price enters into this area of red, it identifies again the mathematical probability between 90 and 95% up here, that even though the market broke through the first target, we got a little bit aggressive and we sold here. We got stopped out, and we've been nibbling in selling short into this resistance level, into this area of accumulation of supply, but we've gotten stopped out a few times. Now, we've been shorting this against long derivatives that we are carrying, such as Nugget, which is up 397. It's up 9% in one day. And we have assets that we have been accumulating, that we've been recommending to our traders here in our private trading room in Discord to build a position in metals derivatives. And that's what we pretty much have been doing, converting any profits that we make into long-term assets. Now, there seems to be a lot of panic in the street with regards to the NASDAQ, with regards to the stock market. And that is the what I call noise, the chatter out there. And in taking a look at the market for the market, using the math of the market, it's given us a weekly buy signal for the NASDAQ. Right now, trading above 11,876, it is a buy signal for the NASDAQ. As we are taking a look in real-time trading, we are looking at real live signals unfolding. So it seems that we have gotten a buy trigger on the NASDAQ, and this is where you can buy. You can buy the NASDAQ at the market. This is the extreme level of standard deviation below the mean. And the principle basically is that it should revert back to the mean, which is 12,462. That looks like a pretty good, strong signal here that we're getting. And let me see if I can pick up one NASDAQ.
Order filled.
We are long the NASDAQ, and it looks like we are getting buyers to come in here. Now, I mentioned to you before, when we're in red, it's usually distribution of supply, and this applies to all of the markets. The VCPMI defines the extremes above or below the mean, and it identifies it in red and blue. When it's in blue, it's accumulation of supply, and it tells you that the price has reached a probability level that you want to go long. You want to buy long and expect a reversion to the mean principle to take you to the target of 12,462. In between there, you see weekly and daily prices that also can be used as targets. Now, you can use the protective level on a close below 11,876. You can use a max dollar stop. And, you know, when you're looking at a trade from B2, since you're looking at a high probability of about 95% from these levels, you can hold on to it until the close if you want to take that risk. So we suggest our traders to use 3 levels of stops. Depending upon your profile. What we're seeing here, coming back to silver, is that the price, even though it's in red, the buying is greater than the selling pressure, which is why we got stopped out. We tested it. We hedged against our long derivatives. It gave us the opportunity to hedge or to take a shot at the short side of the market against our long derivatives. And so we pretty much have neutralized, you might say, any losses that we've taken here in the futures with the gains that we made and that we are making on the derivatives. So in terms of the market, the fact that the price is getting through this resistance level is actually confirming that there is strong buying coming into this market. If the price breaks through the resistance becomes support for the next fractal in price. And as the market breaks through these levels, this resistance levels become support. And that's what's happening here. And so in taking a look at the weekly data, for example, the weekly mean is 2131 and closing about 2131 at about 12:30 a.m. activated 2220 target on the weekly signals for the rest of the week. So if you bought the weekly, and if you're holding on to it, this is a great run for you. And if you have some profits in here, this is the level where you want to lock in your profits or use a trailing stop. So we've been recommending the long side until today, where we obviously got chopped up a little bit here on the short side, testing the short side. And it's basically, once again, confirming that there is solid buying going on. So what we want to see is the buying continue to break through this resistance, and we want to be prepared anytime soon throughout the day the buying dries up into this area that we could see a waterfall reversion to the mean back down to the mean of 2151. So we are holding on to our core long-term position in metals. And we are looking at risk opportunities for day trading. Now, a close below 2190 would activate a short trigger again. We want to focus on what the market is doing, and if we want to continue to trade from the short side, we want the market to confirm it, and that would be closing below 2190 at the end of this half hour. And we tried it a couple of times. We got stopped out, but let's wait until the close so we get more confirmation on the signal. And that doesn't guarantee you that that's basically what's going to happen, but it does increase the confirmation on a more conservative basis by waiting for the market to activate that trigger point by closing below. Let's watch the market here for a little bit. It's gotten pretty quiet up here, and we are coming down to the end of the hour. Once again, we're looking to see the market not necessarily go short on the overall trend, but the momentum has reached the extreme above standard deviation and is giving us traders an opportunity to day trade the market if we want to take that risk. It doesn't change the intermediate to long-term outlook that we have, which is basically much higher prices are coming for precious metals. But the fact that we're looking at this trading tool for day trading, for example, it's certainly providing some clarity in terms of where those opportunities may lie for day trading. Using mathematics, using a probability model, that is about the best way for me in order to trade the market and day trade the market, or just in general take a look at the market from a different perspective than using the fundamentals. So we're trading below 2180. 2190
I'm up for $190
on the
since
excuse me,
I want to give you a copy of my book.
on the close below 2190 will activate a short trigger. The gold market has broken through that resistance, and it's activating basically a bullish weekly price momentum. The daily program has been neutralized because the market is trading above the sell to level, and it has picked up the weekly bullish price momentum, which is the momentum within the bigger trend. So the thing I want to point out to you, which I think is critical, is the fact that the market is trading above 1840, which is the annual average since we published the 360-day seasonal cycle low back in September. This was, it is, for the rest of 2022, the average price yearly. So now we're beginning to see the yearly average price, the market trading above the yearly average price. It's entering into short-term, resistance, breaking through that resistance, neutralizing the daily signals above the extreme of standard deviation. We're getting a weekly price momentum activating 1865, and this is how the magic happens. Basically, where all of the components come together and confirm that the path of least resistance now for the metals is to the upside. We've tested the short side. We can continue to trade for day trading purposes, the opportunities that provide us with day trading. But the fact that now, obviously, the gold market and we're getting a lot of the derivatives continuing to move up here, and we've tried it at 2 or 3 times, nibbled with this. We're going to stand aside and allow for the market to continue to do what it's going to do. The expectations, obviously, is that silver now could break through, as it is right now, that this level of resistance and meet the target of 2220. So once again, my friends, if this is the first time that you're joining me, please take a look at our videos. We trade for the first half hour live, and the room is open for the rest of the day. Take a look at our archives, our videos, click and subscribe. I think that basically this is something that if you're a self-directed trader, it will give you a way for you to navigate this turmoil volatility that we have. Once again, my friends, the market is overbought short term, but it's showing very, very positive signs long term and breaking through resistance levels. If we get a close above 1840, it's going to activate the yearly annual 360-day bullish cycle once again, and will activate the upper end of the targets, which is in the 2003 level once again. Have a great trading day, my friends. We'll talk to you next time. Be well.